Hello everyone and welcome back to the channel. So today we're going to look at the stock repair strategy, and I'm a pretty big advocate of just risk management in general, and I feel that anybody that is running the wheel on stocks and selling cash secured puts and getting assigned and selling covered calls should know how to use this strategy, or at least know that it is available, because it can actually really help you, especially if the stock has dropped significantly below your cost basis. So what we're going to do is we're going to use AMC right here, just to kind of show how to do this. And we're going to assume that we entered somewhere at the 40 level right here, and we can see that the stock now is trading at roughly 30. So we're down roughly 25% or $1,000. And the stock repair strategy is basically just a ratio spread, a ratio call spread. And a ratio spread is basically where you buy and sell an unequal number of contracts. And in this case, it's going to be calls. So what we're going to do is we'll hop in the trade tab here, and we're going to give us a little bit of time. We're going to go out to the September expiration, 37 days. And to enter this trade, what we want to do is we want to buy roughly an at-the-money call, and then we want to sell 2 calls at our cost basis or really close to it. And you can see that right here we have one long call at the 31 strike, and then we have 2 short calls at the 40 strike. And we can open this up for 47-cent credit. You only want to do this for a credit or zero. You don't really want to pay any money to do this. So it's going to be better if you go farther out in time, because if we look at this at the 9-day and try and do the same thing, we're not going to be able to get a credit. So if we go to 40 here, we can say we actually have to pay a $1.22 debit. So that's not really going to work for us. So that's why you want to give yourself a little bit of duration here, just some time to take advantage of basically the increased value of the out-of-the-money options that this extra time value is providing us. So like I said, you want a credit. And basically what we have here, essentially what we have is a free debit spread, or a debit spread that we are collecting a $50 credit for, because one of these calls, one of these short calls, is actually covered by our long stock shares. So we have essentially a free debit spread here, a $9 wide debit spread. And if we go to Analyze Trade, I'll drop this in the Analyze tab. We're also going to add in 100 shares at our cost basis of 40. And I'm also going to add in just the covered call so we can actually compare it as well. So let's go back to the risk profile. So we can see with the risk profile here, with our long stock and this ratio spread here, our break-even point is roughly at $35 a share. So we're down roughly $1,000 right now, because the stock is trading at roughly $30 a share. Our cost basis was 40. As the stock climbs back up to 40 per share, if it makes it that high, we're going to make our $1,000 back on our long stock position right here. But our call ratio spread here, basically that we've gotten for free, is $9 wide. So we're going to make $900 on this spread right here, as well as our 50-cent credit. So $950 would actually be our profit if the stock got up to 40 a share. And we can see that right there. If you look over here, it'll show the number. So we're at $950 right there of profit if it makes it to 40 a share. It's probably not going to come back up to 40. But we can see that if it does come up at expiration, even if the stock is trading at 35, we would break even on this trade, and we could get out of this trade at a break even. If we wanted to stay in the trade, we could do another call ratio spread and try to make more money. But the purpose of this stock repair strategy isn't really an income strategy. It's going to be more of a just get out of this trade without a loss. That is our primary goal here. So now if we compare this to just the covered call, we can see that the covered call has a break-even point of roughly 37 a share. So our break-even point is going to be higher on our covered call, and if the stock comes back up to 40, we're going to make $298. And we can see that right here. It's actually 296, I'm sorry. So as the stock comes back up to, if it makes it up to 40, we will make basically our $1,000 back that we're down on the stock right now, plus the credit. And if it stays above 40, it's both the same thing with the ratio spread and the covered call. At $40, our gains are capped, but we'll make more money on the ratio spread. But we can see that just the covered call, our break even is higher. So, we're going to have to get up to 37 just to get out of this trade at break even. Whereas the stock repair strategy, which consists of the ratio spread, our break even is at 35. So it's almost $2 lower. I think it's about $1.75 lower, somewhere in that area. So, we'll be able to get out of this trade sooner if AMC comes up a little bit. So anyway, if you guys have any questions, just feel free to ask in the comments. Also, I have both free and paid Discord chat groups. There should be a link in the description for those. The free one is, obviously free to join. The paid one starts at $3 a month. But you can come in there and ask a question. I'll do my best to answer for you. But anyway, thanks for watching and have a great day.